Gold gave up about half of its $100 gain. We closed just above 4,050. Silver up about $1, closing at 58.58. Now, one of the reasons there could be some nervousness surrounding tomorrow's release of the PPI, when people believe higher inflation is bad for gold, when in fact gold is an inflation hedge. And the more inflation we have, the more you need to hedge yourself. Again, the government tries to tell us that prices going down would be horrible. How would it be horrible when so many people are suffering from high prices? Look how much food prices have gone up. And then the Fed monetizes those deficits, artificially suppresses interest rates in large part to make it possible for the government to finance those deficits without having a crowding out effect on private credit and pushing up interest rates. Middle class don't have a lot of savings anymore because taxes and inflation have pretty much wiped it out. They still have pensions, annuities, cash value in an insurance policy. They have a lot of saving vehicles that get harmed. So the markets immediately celebrated. Bond yields fell, bonds rose, and gold spiked $100 an ounce. Now, first of all, it's not even really good news on inflation because the main driver of the 0.4% drop was the oil price decline. Oil was down about 30% in May. Why? Well, because supposedly the war with Iran was over. We had the MOU, we had the ceasefire, so oil prices went down 30%. Well, now the ceasefire is off, the war is back on, and oil prices, which are now back up at $80 a barrel as of right now, oil prices are up 20% so far in July. So July is only half over. It's possible that the entire drop in oil prices that we enjoy in May, or in June rather, because the war was off, are going to be taken away in July because the war is back on. So why even celebrate what really amounts to a meaningless number? What's more important is that we're way above 2%, and we're not going to get anywhere near 2%, no matter what the Fed does. And of course, what's more problematic is that these are the government numbers, the official government measures of inflation, which maybe capture half of the actual price increases that Americans are forced to endure. Now, gold gave up about half of its $100 gain by the end of the day. I think gold ended up closing up about $50 on the day. We closed just above 4,050. Silver up about $1, closing at 58.58. It got clobbered a couple of bucks yesterday, but I think the most significant action was in the bond market because the bond market lost almost the entire gain.
What if the next economic crisis isn't just another recession, but something far more damaging to your savings, your investments, and the value of your money? That's exactly what Peter Schiff is warning about. While headlines celebrate slightly lower inflation numbers, Schiff believes investors are missing the much bigger picture. He argues that massive government debt, relentless money creation, and stubborn inflation are quietly setting the stage for a much deeper financial crisis. At the same time, central banks around the world continue accumulating gold, geopolitical tensions remain elevated, and uncertainty over future Federal Reserve policy is keeping investors on edge. Could gold and silver be signaling what's coming next? Let's break down Peter Schiff's warning, what it means for precious metals, and why every investor should be paying close attention. Let's dive in.
By the end of the day, the yield on the 30-year Treasury was back up to 5.1, and the 10-year is back to 4.59. So almost the high watermarks, despite this better than expected inflation number. Now, one of the reasons there could be some nervousness surrounding tomorrow's release of the PPI. We're going to get that tomorrow morning before we get day 2 up on Capitol Hill. And the producer prices have been coming in a lot hotter than consumer prices. Of course, the producer prices are also going to benefit from the drop in oil prices that we had last month, which is pretty much being undone this month. So again, I don't know why the markets would pay attention to such backward-looking data that is really irrelevant, but that's what they do. And this is how these algorithms are programmed, and they trade off the numbers. I just think that people should take advantage of any of these moves. In fact, when people believe that inflation, higher inflation, is bad for gold, when in fact gold is an inflation hedge, and the more inflation we have, the more you need to hedge yourself, should take advantage of this misguided idea that higher inflation is somehow bad for gold because it means the Fed has to fight harder to bring inflation down. What it really proves is that the Fed can't bring inflation down. It doesn't have the wherewithal or the ability to do it because of all the other problems that would be exposed if the Fed were to do that. And that kind of brings me to the discussion of today's hearing before Congress. And what's the most frustrating part, of course, about the entire hearing is that they're there to discuss inflation. And nobody, except maybe Walsh, but he doesn't want to let the cat out of the bag, but the entire discussion centers around a term that nobody properly defines. Everybody acts as if inflation is rising prices. And it's not. I've talked about it on this podcast many times. Inflation is an expansion of the supply of money and credit. That is what is being inflated. You can't inflate a price, you inflate money supply, because inflate means to expand. And if you're going to have a discussion about inflation, but you're misdefining what the term means, then your whole discussion is meaningless. Because prices go up, prices go down. Inflation is a whole different problem that causes the general price level to be higher than what it otherwise would have been absent the inflation. It doesn't even mean that prices go up. It can simply mean that inflation prevented prices from going down. Now, again, the government tries to tell us that prices going down would be horrible. How would it be horrible? Especially when so many people are suffering from high prices. Look how much food prices have gone up over the past several years. Would it be such a disaster if they came down? Of course not. I mean, why do they have to keep going up? If the problem is food prices are too high, having a target of, well, let's have them go up another 2% a year, that doesn't solve the problem of prices being too high. That makes them higher. What would solve the problem is if prices actually came down. And that would solve a lot of problems. Consumers want the price of everything to go down. Yet, according to the government, that would be a disaster. The government is there to make sure that prices don't go down, to save us from the pain of being able to buy stuff for less. Right? This is what the government is selling us on. So that's the biggest problem is a misunderstanding of the term. But then the other thing that really frustrates me always about these hearings is that you've got all these congressmen and women, right, that are upset about inflation, and they're asking the Fed, what are you going to do about it? What's your plan? How are you going to stop this inflation? Meanwhile, they are part of the reason that we have inflation. It takes two to do the inflation tango. Congress has to spend money it doesn't have. It has to have deficits. And then the Fed monetizes those deficits. And the Fed artificially suppresses interest rates in large part to make it possible for the government to finance those deficits without having a crowding out effect on private credit and pushing up interest rates. So it is the Congress, and of course the president, because he's signing on to all this spending, and the Fed. It's a combination of monetary and fiscal policy working hand in glove. That is why there is inflation. Yet the very congressmen and women that are voting for the deficit spending that is ultimately the source of the Fed, of the inflation that the Fed creates, they're yelling at the Fed as if they have nothing to do with it. They need to look in the mirror and recognize their own responsibility. And then, of course, the Fed chairs, they always deny their responsibility. They want to blame tariffs. They want to blame the war. They want to come up with all kinds of excuses about where inflation is coming from. The cause of inflation is right there in that hearing. It is being caused by all the representatives and the Fed. They're there discussing a problem that they've created, and they're pretending that there's some exogenous solution. And then when Warsh talks about how, we're going to do things differently, we're going to solve the problem, without actually getting into what would need to be done to solve the problem, which is why they're not going to solve the problem. But artificially low interest rates also have clear winners and losers. Who wins from low interest rates? Debtors. The debtors win. Who loses? The creditors. They lose. So it absolutely does pit one interest against another. It favors the debtor relative to the saver, especially wealthy leveraged debtors who have borrowed to accumulate assets. They really win because it makes it cheaper for them to borrow. And then inflation wipes out the value of what they owe. So they're winners. The losers are the savers, which tend to be more of the middle class. And even if middle class don't have a lot of savings anymore because taxes and inflation have pretty much wiped it out, they still have pensions, annuities, cash value in an insurance policy. They have a lot of saving vehicles that get harmed by inflation. But also, who benefits from artificially low interest rates? The government, the federal government. The government is the biggest debtor of them all. So the government wins. But the savers, the people who bought government bonds, the people who loan money to the government, they're losing, right? They're getting a lower return. And, who owns a lot of those government bonds? Insurance companies own those government bonds. And that means they have to charge higher premiums to Americans who are buying fire insurance, life insurance, car insurance, because they're not getting as high a yield on their bonds. They have to charge higher premiums to their customers.
Peter Schiff believes the market is focusing on the wrong story. While investors celebrated softer inflation data, he argues the decline was largely driven by temporary weakness in oil prices rather than a meaningful improvement in inflation. As geopolitical tensions pushed energy prices higher again, Schiff warned that inflation pressures could quickly return, making recent optimism short-lived. According to Schiff, inflation isn't simply rising prices, it's the expansion of the money supply and credit. He argues that persistent government deficit spending, combined with Federal Reserve policies that keep borrowing costs artificially low, continues to weaken the purchasing power of the U.S. dollar. In his view, these structural problems cannot be solved with a few favorable inflation reports. One of the biggest signals Schiff watches is the bond market. Even after the inflation data, Treasury yields climbed back toward recent highs, suggesting investors remain skeptical that inflation is truly under control. Schiff believes this disconnect shows that financial markets are beginning to question whether the Federal Reserve can restore long-term price stability without creating even bigger economic problems. For gold and silver investors, Schiff's message is straightforward. Don't confuse short-term market reactions with long-term fundamentals. He argues that gold has historically served as a hedge against inflation and currency debasement, while silver often benefits during periods of rising inflation expectations and growing industrial demand, although it typically experiences greater price swings than gold. Today's global environment adds another layer of uncertainty. Central banks continue purchasing significant amounts of gold to diversify reserves. Government debt levels remain historically high, and geopolitical risks continue to influence commodity markets. Whether it's concerns over inflation, fiscal deficits, or international tensions, many investors continue turning to precious metals as part of a diversified long-term strategy. For Schiff, the real danger isn't simply a recession. It's a prolonged loss of purchasing power driven by excessive debt, monetary expansion, and policies that continue to favor borrowing over saving. So what happens if these trends continue? Here's the bigger takeaway.
So that's another way that the middle class suffers from artificially low interest rates. And the government benefits and other debtors from the ability to borrow. So I don't know if Warsh actually believes this. This is a very simple point. Does he not understand that there are two parties to a loan? There's the lender and there's the borrower. And that if you advantage one, you disadvantage the other. Does he not get the distinction there? I don't know. But that's what he said. And I was actually surprised that he made a comment that was that incompetent. Now, another point that I wish he would have made more clear had to do with black workers. And, whenever there's one of these hearings, inevitably you get an African-American representative, typically, asking the Fed chairman, what are you going to do specifically to help African-Americans? And in this case, it was African-American workers who this representative claimed were disproportionately impacted by rising unemployment or inflation, whatever it was. But she kept saying, what are you going to do specifically to help African Americans? Now, Warsh just ignored her question, which probably upset her, which is why she asked it a couple of times. But I wish he would have just had the courage to be more candid and actually reply and say, you know something, Congresswoman, there's nothing we could do. I understand you're concerned about the plight of black workers, but the Fed can't do anything about it. Like we can change interest rates, but how does that affect a black worker versus a white worker or a Hispanic worker? I mean, they're all the same, right? We have, a couple of levers, right? Print money, don't print money, cut rates, raise rates. There's no, lever that we can pull for African Americans. There is no specific policy that can be targeted. Why not just tell her that? Why not just level with her and say, look, this is not the place for you. He's afraid. He's afraid to speak up. Nobody wants to criticize anybody for asking these ridiculous questions. But even better, what I would love to see Kevin Warsh do is say, you know what, Congresswoman, I appreciate that you're concerned about black workers and, the problems that they're facing. Why don't you do something about it legislatively? Why don't you start repealing a lot of the laws that Congress has passed over the decades that are disadvantaging African American workers? They are being disproportionately impacted by all the war on poverty, Great Society, welfare programs starting from the 1960s. And all of the laws, the anti-discrimination laws that have been passed have backfired. Everything the government has done to help African Americans has backfired and harmed them. It's got nothing to do with the Fed. Yeah, I mean, the Fed harms everybody, right? They're an equal opportunity harmer. Their bad monetary policy and their inflation, sure. And you can say, well, if blacks are disproportionately poor and middle class, then maybe they disproportionately suffer relative, from inflation, which may be true. But there's no way that the Fed can target that relief to the African Americans. Right? They could just paint with one big brush. But if Congress actually repealed a lot of these laws that, maybe they were well-intentioned. I'll give them that they had well intentions. But, the road to hell is paved with good intentions. And in this case, it's the African Americans who are in hell as a result of that well-intentioned legislation. Now, in many cases, it wasn't well-intentioned. The actual purpose of the legislation was to trap African Americans in poverty to secure their votes so that they can hold out an escape from poverty.
Peter Schiff's message is clear. The biggest threat may not be a traditional recession, but a deeper monetary and fiscal crisis that could reshape the financial landscape for years to come. Whether you fully agree with his outlook or not, keeping an eye on inflation, government debt, central bank policy, and the gold and silver markets has never been more important for long-term investors. If you enjoy in-depth analysis on gold, silver, the economy, and wealth preservation, make sure to subscribe, turn on notifications, and join our growing community so you never miss an important market update. Now I'd love to hear your opinion. Do you believe gold and silver are preparing for their next major move? Or do you think the market is overreacting to today's economic risks? Share your thoughts in the comments below, and I'll see you in the next video.